What's going on, guys? It's Kyle. Welcome back to the Stock Goat YouTube channel. I want to apologize for taking off the past 3 months. I just wanted to avoid the stock market overall. Every single day I was on Twitter a little bit, but I want to start doing some more YouTube videos very soon. So be sure to smash the like button. Let's try and get this video to 500 likes, and don't forget to drop a comment. What have you guys been up to? Have you been buying the dip, lately? What did you think about the SoFi earnings? I want to hear your guys' comments. I'm going to be commenting back to everyone. But guys, I see a lot of upside in the near future just because we're seeing that, nasty inflation drop dramatically. So potentially we'll get, a Fed pause. Maybe they won't keep hiking up the rates, but maybe they'll just pause for a couple months. And that could be, good news for, growth stocks, fintechs, because, more money could potentially start flowing again. But I see so much upside for SoFi in the next, couple of months. And I'm going to, tell you guys the reasons why I believe that. We'll also go over the earnings. I'm going to tell you right now, I don't think the earnings were absolutely amazing, but every company is going to have a decent earnings occasionally. But still, we saw, growth in some areas, user growth, everything. So I'm going to give you guys, the pros and cons of what I saw and things I'm looking for in the near future. So be sure to smash the like button. Let's get into this video. All right, guys, I'm going to tell you right now, I have taken off about 3 months, and when I did my last video, I think the SoFi stock, believe it or not, was about $5.50. So I vanished for 3 months and we lose, another 50 cents. Okay, so good things have not happened yet for SoFi. We've been trading around these levels for, it seems like, a year or more, guys. I've been, following the SoFi stock before anybody. I mean, it could have been 2.5 years ago I started making YouTube videos about SoFi. If you scroll all the way down to the bottom of this YouTube channel, and the reason why I like this stock is because of what they were showing in the investor presentation, and then once they went public, they were, following what they said they were going to do in the investor presentation. And there's probably 80 to 85% of SPAC stocks that did not do that. SoFi did that even with the circumstances that they had. And, those are some nasty circumstances. We're talking the bank charter took a freaking additional, what, 9 months or something like that. That was on backlog forever on getting that approved. And then, of course, you got 3 years of, no student loans. Those are the two things that I believe set SoFi back about 1 year. Okay, so I think their numbers could have been exactly where they wanted to be on the investor presentation. They just got screwed, 1 year, and they still were able to, navigate and, do as best as they could. And I believe that's because they got a lot of good, management, that are, still in this for the long haul and want to get their, massive bonuses, seeing SoFi, go up dramatically, 20, $30 or something like that. So the market cap right now, we're back to 5 billion. I mean, this is crazy, guys. This is under book value. I mean, the book value is the way you just price, the equity assets or whatever it is, the value of like the banks. They're supposed to be trading at like a minimum of one book price to book. And guys, I mean, this is absolutely insane. You're getting this under book value, 30 to 40% growth stock. I mean, it's incredible the prices we're still at right now. I mean, JP Morgan is like 1.5 price to book or something like that. All right, guys, we can see members growth is just consistent. Look, the last 5 quarters straight, they just kept it right in between 400,000. Looks like that's just where SoFi wants to be. And, I'm not really complaining if it's, higher or lower than 400. This is just where they want to be at. Products, looks like 46% growth. Overall products, 8.5 million. That's not bad. This is the red flag that I think, it wasn't a lot of talk about, but the Galileo counts because, this is one of the services that SoFi is really pushing out, that they have like the best products for, these big legacy banks and stuff, these other fintechs. And we had a slight pullback in members for the first time ever. I mean, this is crazy, guys. They lost 5 million accounts, and this is because they lost a big player that they had signed, and the reasons weren't disclosed of exactly why they lost that account. It could be that company wanted to have cost savings, etc. But when you're seeing what you expect to be your fastest growing segment in the future go backwards, this gets a lot of investors and analysts concerned. But I believe, from what they said, they really think they are going to land a big player in the future. This could be, a Morgan Stanley, a Goldman Sachs, a Truist. You never know. I don't think it's going to be, Bank of America and Chase, because those guys just want to, a lot of ego. They don't want to partner up with these little fintechs. So we're not going to get a top three legacy bank, in my opinion. It's going to be like the seventh, the 10th that want to, get to, match those top three legacy banks. So it's going to be a legacy bank that wants to compete with, a JP Morgan, a Wells Fargo, and Bank of America and stuff like that. So lending products still growing 24% year over year. So the exact same as the last 2 quarters. That is absolutely incredible. They don't want to go all in on lending. Financial services still growing nice, 51%. This is amazing, guys. This is what they've been talking about that they want to do for so long. Ratio of financial services to lending products. They want to get out of lending because there's always risk in lending, even though you got high quality members, and they want to go to these financial services products. And look at that, Q1 2021 they were at 2.4x product to product, and now it's at 5 times more. That is absolutely insane. What if this goes 10 to 1 in the next 1 to 2 years, guys? That is incredible. That's just getting rid of that risk, that high risk, with 5-10 billion originations and lending. They want to just diversify their revenue into other segments, and financial services is doing very well. Revenue, guys, growing very nicely. Not an insane quarter. Adjusted EBITDA did slow down a little bit from what they had Q3 to Q4. There's a couple reasons why. And looks like they are just putting out these guidances that we always get concerned when their guidance is a little not stellar, but they always blow the guidance out. Look at that, guys. They blew the high end out by 20 million on the revenue guidance. So that gives you kind of what you should be expecting for the next quarter. And it looks like they raised their guidance very nice for Q2, in my opinion. Look, guys, it went to 480. I mean, we could be looking at a $500 million quarter, and we just did 460. That could be a $40 million jump. Adjusted EBITDA, they also blew adjusted EBITDA out by 30 million. So if they're putting their adjusted EBITDA out at 60 million on the high end, I mean, it could be a big adjusted EBITDA quarter, 90 to 100 million. That's what we want to see, guys. So growth, of course, it's not going to be absolutely stellar from what they're putting out right now, 27 to 31%, but you got to think we also lost, mortgages because rates are at 7%. Student loans are nowhere to be found. You put these two segments back in your business models, guys, you're looking at 40, maybe 45% growth. So if those two things come back, I mean, even though we're, just grew nicely in 2023, 2024 could be a 40% growth year as well. And you're not seeing that in these, larger companies that have been around for a long time, especially these big banks. So what I really want to be looking at, guys, right now is what makes me most excited is the originations on their lending segments, okay? So this, of course, is the most recent updated presentation, and you can see they had student loan originations, 500 million, personal loans were 3 billion, and then home loan originations, let's call it 100 million, guys. Home loan originations, 100 million, guys. So if we go back on the home loans and the student loans, guys, you got to see this. So this is the presentation from 2020, guys. Look at this. Student loans were at 2 billion originations at one point. And if we look at the peak for home loans, guys, look, it went from 6 to 600, 700. It peaked right here at about 800 million. So think about that, guys. 500 million where we're at now to 2 billion was our origination high on student loans, and then home loans 100 million to 800 million. You're looking at 300% upside on student loan originations, where we were in the past, and 800% upside on mortgage loan originations. So when you're seeing lending stall out a little bit this quarter, just think about it. That's just personal loans carrying all the weight because these two products are virtually non-existent to where we were at. I mean, student loans are decent, but mortgage, I mean, you're talking to 8x. Student loans a 3x, guys. We need to get these two back and, see a little bit of a pullback on student loan or on personal loans, and then you're going to see lending just, continue to grow because these are going to carry the weight once personal loans pull back. So you're going to continue. I mean, we could be at, I don't know, what is it, guys? 7, 8 billion originations for everything combined. 4 billion on personal loans, 3 billion on student loans, a billion on mortgages, guys. I mean, there's so much upside in lending. I mean, we could be pulling another 2 to 3 times profit where we're at in another 1 to 2 years. We just have to wait for the economy to bounce back and, interest rates drop, student loans resume, and, we could be looking at major upside. All right, guys, we're always talking about, when is SoFi going to potentially be profitable? They said the exact same thing last quarter that they see profitability in Q4. Let's just assume profitability, this might be a little bit higher than what it could be at, but let's just assume $50 million. dollars. And, it could be like 20 million, but assume $50 million. This finally gets SoFi to have a PE ratio, assuming that they do the same thing in the next 4 quarters. So if they do 50 million profit, that's going to be 200 million, like a full year profit. So we could actually finally get a PE ratio on SoFi, assuming that they, pull 50 million in Q4. Okay. So think about it. 5 billion is their market cap divided by 200 million. That'll give us a 25x P ratio. The big banks, of course, are about 10. But guys, if SoFi can really put up this type of growth, I mean, you're buying at these levels right now of a 25x P ratio, what, 6 months away? You can see the P ratio for Tesla in the crazy peak, it peaked at about 966, okay, guys? They said the auto cars market, has no technology. You got 1,000 PE on Tesla. Okay, so they definitely separated themselves from Ford, GM, and all those other companies, and that's what we're trying to do with SoFi. Okay, I'm not saying we're gonna get 1,000 PE ratio, but assuming that the growth really does, pick up and student loans come back, mortgages come back. I mean, if you have that type of growth, you can get a Nvidia type of PE ratio if you're not a bank stock. You finally go back into tech, we could be at like 100 PE or something like that at one point, and then it just continues to catch up with itself long term, 50, 25. And then look at Tesla. It caught back up. Look, it went from 1,000, now it's at 44. That's still an insane PE ratio for a car company, but then you got the tech. Tech is what gets it that type of valuation, okay? So we are a bank. We are being priced as a bank with these analysts, and it sucks. You're getting price to book 1. Okay, maybe we should get a price to book 2 or 3 or something like that. That's why you're buying the stock. You're buying it for the potential profits in the future. So guys, we can see that federal student loan repayments to restart. Education secretary confirms. I mean, if we scroll down a little bit, the timeline, this one doesn't show, but it says, okay, student loan services are reportedly required to alert borrowers of payment resumption by August 31st. Okay, so the reason why I believe that this potentially could be legitimate is because you got the COVID-19 national emergency ending, and when you talk about Biden ending an emergency on COVID-19, that means they finally given up. They're not, go get your 19th vaccine. Moderna and Pfizer probably, locked in as much profit as they possibly can. So you don't have this emergency any longer because, all the profits are dried up pretty much because it's been 3 years. So that's why you got student loans potentially coming back in the next month or two. So a lot of upside. Once again, we go back to my, overall view. The cons: Galileo paused, lost a big client. Personal loans revenue paused. Pros: financial services revenue exploding, losses declining fast. In-house mortgages cost saving in the future where they acquired that company. Cash position is incredible. We didn't even look at that. It's over $1 billion. Stock-based compensation, we didn't look at that as well, declining. So yeah, these are some cons. Personal loans pause. Galileo pause, a little decline. But, there's a lot of upside in the future when you're talking about 800% upside in mortgages, 300% upside in student loan originations. I mean, this is just what SoFi was doing, in 2020 and 2021. So we could surpass these numbers in the future if, all of the rates and stuff like that get corrected. If you made it to the end of the video, I want to say I really enjoyed making this video for you. Be sure to smash the like button. Don't forget to drop a comment. I really hope everybody's been doing well. Let me know what you guys have been doing. You've been dollar cost averaging and stuff like that. How have you guys been? I want to hear it. I'm gonna be coming back to everybody in the comment section. So let's just hope good things happen in the future. Let's get these student loans started back up. Let's get a little pause and a rate hike so we can get the mortgages back, and hopefully we get a profitable quarter soon, and then bigger profits in the future and superior growth. And that's where you get these crazy valuations. That's what everybody wants. We want a crazy valuation. We don't want a bank valuation that's just 5% growth a year, 10% earnings growth. You know what I mean? We want, 40, 30, 40, 50%. That's what we're investing in. Future growth, brick and mortar to digital. Okay. That's why you're buying this stock. Okay. Hasn't happened yet, but it could all snowball at once when you get these cost savings from, this mortgage company and, student loans, another two business segments is coming back to life. That's where you get a snowball effect. So once again, my name is Kyle. Hope you have a great day.